Happy Tuesday, everybody. Thanks for joining to our biweekly commercial meeting. Looking forward to our presentation today. We have our partners, our CoStar partners on the session today. I'm going to let our good friend and amazing rep Ricky Dillon to present our other members from CoStar, and then we're going to let Ryan, who's going to lead the meeting with the presentation. Then we're going to open for questions and whatever you guys have in mind. Ricky.
Thank you, Manny. I just want to say thank you all for joining and allowing us to come in and share some information with you. We do have some new updates in CoStar that we can always kind of go over. Like, I don't know if anyone's used the new CMBS information yet. It's new information that we now have in CoStar that you can look for, 30, 60, 90-day defaults in CoStar by just going into the filters tab and selecting the loan tab in the filter, in the search filter, and you can find that very, very easily. I'm just going to go through a few things for you guys today, and then Ryan's going to pick up pretty much everything from there under market analytics, which is everything will be that you can refer back to. You'll be able to find in something called analytics on the home screen. But let me just go ahead and let me share my screen real quick. Bear with me a minute. Can you just disable the participant sharing, Manny? Can you just give me the rights?
Okay. Yeah. See if you can do it again.
All right, great. There we go. Let me know, everyone, when you can see my screen. You should be looking at the news tab. Can you see it, Manny?
Yes.
Great. So what Ryan's going to go over is pretty much market updates and everything you can find in market analytics. What I'm going to talk to you about today very quickly is the new content in CoStar. If you go to all properties, so you're going to go there, and then you're going to go to don't worry about the property types. You're just going to go to filters, and then from filters, I want you to go to the loan tab. Okay, and then from here, you're just going to go down, and you can go. You can select a few things, but you can go pay status, and then you can look at your 30, 60, 90 days. You could look at all of them. Actually, you can just go here, but I would go here to not performing, and then zoom out a little bit more. And then if you were going to look at one of these properties, the map just load real quick. So if I was going to look at one of these properties and see where they're at, I could just click on it. And then what is also new is, besides under the loan having the information here in the terms and the contacts and performance, here it shows 30 days. But we also now have the financials tab. So this is also something brand new that we just launched that's available as a value add. So now we have the income, we have the effective gross income, including parking and expense reimbursement, base rent, and then we have the operating expenses. And then we've got the NOI and the capital items. And so we never had this before. So it's great. It's new content. And then it all ties in also with our public records. So you can go in and look for like loan information, like loan to value, and also like origination dates. So so another trick you can do is, like, no matter where you are in CoStar, if you go up to the tab you can always right click and hit duplicate. So you just create another tab in CoStar so that you don't lose where you were, but you can start a new session. So now I'm going to go into the public record. So you can go into it just like everything here. You can go to sales comps. Like, for example, you can go here and then this is all your sales comps, or you can go into the tab. So instead of going here to public record, I'm going to start it, since we're talking about loans, we're going to start from the home tab. And now we're just like these other tabs you can go into when you're in a property record. We're going to go to public record. And again, you can choose your primary type, but we're just going to go to filters right away. And then we're going to look at, we're going to go down to origination date. You can just put that in. Maturity date, when's it coming due? And then you can also look at like the different loan types. And this is just a way to filter your prospecting. Again, this is also new that I wanted to make you guys aware of it. And again, getting back is simple, but like I said, I like to use the duplicate so I can keep those open. And then you can always start a new session with CoStar. Those are just a few of the new the data areas that we just launched in CoStar. And just know that to find me, it's pretty easy. If you go to the bottom of your page, I should be right here. And then if you ever have like a listing question, you can always find like whoever we don't call them researchers anymore. Now they're your relationship consultants. They would be right here at the bottom of your homepage in your CoStar news. So if any questions come up in the future, I'm available. I can do a one-on-one. I just did one with Joseph the other day in West Side. And just let me know. And thank you very much for your time and your business. And I'm going to kick it off to Ryan, our Director of Market Analytics. So thanks, Ryan, I'm gonna go ahead and give you control if I can. Or Manny, I think, can you do that?
I got it.
You got it. Great.
See my slides?
Yes.
Yeah, perfect.
Awesome. All right. Well, good afternoon, everybody. I'm Ryan 𝐸𝐻𝐻𝐻, a Senior Director of Market Analytics, where I cover LA County commercial real estate. My job is to stare at the 4 major commercial property types every day and write about, talk about, communicate what is going on in the market. So to say, so to look at everything, kind of what has happened during the pandemic era, most commercial real estate has been negatively impacted from the events of the past year, with the exception, I would say, is industrial. Office and retail definitely had some, pretty severe impacts there. Multifamily was more adversely impacted than the rest of the nation. We have seen a recovery kick in pretty well, but there are some question marks that remain around the evictions and with the moratorium and how that will play out. But by and large, definitely some improvements that need to be made to get back to pre-pandemic levels, but we'll start there. So I will start with the multifamily sector and then go into office, industrial, and then wrap up with some thoughts on retail. LA's multifamily sector was more negatively impacted from the events of last year with respect to occupancy losses and the movement of rents. However, the story there is really stratified, and you have to look at the various segments of the market. Cheaper apartments versus more expensive apartments, more suburban locations versus more urban locations. Lots of different things happening within those spaces. Over the past year, it's the cheaper, more suburban, more space for your money. Those locations have fared better. The dense urban areas, those amenities, the pre-pandemic, everyone liked, enjoyed. You can walk to things out your door. That has resonated less with people, and that may change, but then also the events of the last couple of weeks with Delta, lots of question marks there. This graph looks at supply, demand, and vacancy. So looking at the net absorption of apartment units in LA versus the supply that was delivered during a certain quarter, and then that kind of impacts where vacancies go. As you can see here with the green line, vacancy increased quite considerably in 2020. It was, pretty considerable and got to the highest levels in over a decade. And we have seen, luckily, a strong improvement, however, in 2020. Vacancies have come down. They're still not at pre-pandemic levels, but we are seeing pretty steady improvements. And again, this is looking at the market on a market-wide basis. And again, multiple stories going on here. Just to compare kind of where we are with the nation, as you can see here, the pandemic didn't really impact the national apartment market all that much. Occupancies held flat, and like the LA market, things have come down quite considerably over the past year. However, nationally, conditions are much lower than they have been historically. And so there is a strength in the apartment market. We also see that in the for sale market as well. So by and large, housing is doing quite well. To kind of break out the various areas in LA County, these are our submarkets in terms of how we define various sections of the metro. The picture here that I'd like to paint is that areas that are either more expensive or have seen more new supply come online in recent years are dealing with elevated vacancy levels. Conversely, more suburban areas, areas with a concentration of lower quality or larger units, areas that are harder to build. Most of LA County, most areas are quite NIMBY, very hard to get things done. And so you see that these areas where there has been more development or towards the top of the market have fared not as well. One of the interesting things that we have, we own apartments.com, and that gives us a great view of the apartment market with apartment data. This is feeding into CoStar. We get over 90,000 rent collections daily from this database. But I like this data set in particular, and this looks at search activity. So it's a relative leading indicator of where the market could be going. You have a prospective tenant, they start to look for an apartment, they go tour, they sign a lease, they move in, and then that's where that impacts vacancy. As you can see here, towards the end of last year, there was definitely an impact from the surge in LA County with the pandemic. Activity did fall off, but 2021 so far, based on the data that we do have, things continue to be strong and definitely portend good demand for the sector. Another data point I'd like to point out is the availability rate. So this is leading vacancy, and that when someone signs a lease, the apartment goes off the marketplace. And so vacancies have been declining, through this year, and the last couple months has been pretty, seen that pace increase. In terms of where the market could be going, definitely some uncertainty there. We have the eviction moratorium that we will have to filter through. So there seems to be some situations where people are staying in their apartments, but they're not paying rent. Well, what that means for our data is that's not impacting vacancy, but I do think that there is some latent weakness in the market that could come up. But the people that can afford apartments and are moving in are driving down vacancy at the moment. And based on this scenario, we do expect vacancies to continue to decline at a pretty measured pace, but relatively favorable, and the market will continue to improve. This graph looks at rents for one bedrooms, comparing these rents in LA compared to the nation. And as you can see in this graph here with LA in green, the rents in LA do not fare as well as the national average, and rates are much higher now, above 6% of where they were in January 2020. Coming into the pandemic, we just passed pre-pandemic levels in late June. When you look at the rent dynamics by unit size, the clear message here is that larger units have fared better. People have sought more space, surprise, surprise, during the pandemic as they've been spending all their time at home. And I think the uncertainties of things right now too at Delta could continue that trend as well. Conversely, one bedrooms and particularly studios have not fared as well. Looking at rent growth by submarket, the key message here is areas that have seen greater supply, are more expensive, are on the right side of this graph. Areas that are cheaper, more suburban, offer more value for your money are towards the left. It's a very clear dynamic that's playing out. Through apartments.com, we also have a sense on concession levels. And as you can see here, this looks at communities over 25 units. And while we have come down a bit, concessions do remain elevated. And so we have seen vacancy come down quite considerably, but that is being driven to some extent by the concessions that are being offered. So until this number comes down lower, I would be reluctant to say that the market is in a particularly strong position. It's not particularly weak to me, but there definitely could be some more improvement to be had. Now, looking at deliveries, this speaks to this message again. LA, it's very hard to build in most areas of the county. And so developers really focus on those areas that are receptive to development, like downtown Los Angeles, Koreatown, Hollywood, Woodland Hills, around the Warner Center. There are these pockets where it simply is just so much easier to get things done versus the more suburban, plenty of NIMBYs in the area, fighting every single development through CEQA and other measures. And so that is kind of where development has happened over the past year. This looks at the past 4 quarters, but most of this is pretty similar, I would say, over the past 5-7 years as well. And so that's kind of the picture there. Now, apartment construction, as we can see here, is relatively elevated when you compare to the past 2 decades. That being said, we aren't building enough apartments on a metro-wide level. The housing affordability crisis year in, year out continues to get worse. We are building lots of units on a historical basis, but the development is concentrated in the higher end, what we call 4- and 5-star properties, newer buildings, towers, the shiny buildings you see in downtown LA. That is where it's concentrated. And so we do need more housing supply, but that's not for the typical renter, the one that is strained and affording apartments here. And so we have this dichotomy where the high-end apartments are being built. That's leading to elevated vacancies, but there still is this need, despite this elevated pipeline in the market. Now, looking at where construction is happening by submarket, this is pretty similar to that graph I showed you in terms of what delivered over the last several quarters. Downtown LA, Woodland Hills, almost all of it by the Warner Center, Hollywood, that's where you're seeing the largest amount of new supply underway. Looking at sales volume, we have seen activity kind of pick up after, a fall off in the beginning of the pandemic. There was a bit of a fall off there. Let's see, do I have anything on Kern County? I do not, but you can access our reports for Bakersfield through the CoStar website. Now, getting back to sales, definitely, pullback in activity and moderation there, but we are seeing investors come back into the market. But what is interesting about this year is almost all the large transactions, the major, several hundred unit apartment communities that have traded, they've all been purchased under this structure to convert these newer buildings into mixed income housing. And this is being done through tax-exempt bond financing through local authorities. And so investors are buying these buildings and converting there. So interesting dynamic going on. And I think that is promising in terms of helping alleviate some of the pressures. But I just want to point that out because the volume is really being driven by non-traditional transactions. All right, thank you, Michael. And so this graph looks at our pricing per square foot, looking at pricing on a per square foot basis. And so as you can see, pricing didn't really decline during the pandemic, which, to be frank, surprised me. There's a lot to be fleshed out in terms of how the apartment sector is going to be used. Sorry, talking the wrong sector here. But with apartments, pricing was relatively flat. And we did see, but pricing is starting to increase. And so I think that momentum is starting to pick up. And we do anticipate prices to increase at a relatively modest pace through the rest of our forecast period. I'll now move on to the office sector. The office sector clearly experienced an inflection point as a result of the pandemic. Almost overnight, the market went from vacancies at the lowest point in a decade to spiking at a rate that we hadn't seen since the GFC in 2008. So pretty dramatic on a dime how the market changed. And coming into this, the market was really strong, but it wasn't relatively mature conditions. leasing and vacancy was basically going sideways. We weren't really losing in occupancies, but we weren't gaining. So we were a later stage of the cycle, but clearly overnight the market changed. Vacancy is now at 13.5%, levels that have not been this high in at least 25 years as far as our data set goes back. This first graph looks at gross leasing activity, representing the square footage of leases signed during a quarter. So to me, this is a relatively leading indicator. Tenants are on the market, they sign a lease, they usually move in a couple months after. And so this is giving us a sense of where vacancies could be heading. Activity has picked up a bit, and we are seeing, and this is promising. Q2 is kind of the first quarter that I think we've seen activity back to pre-pandemic levels. So promising there, but the rise in vacancy hasn't really stopped yet. As you see in this graph here, we're well above the previous peaks of the last cycle, highest levels in at least 25 years. So a lot of question marks in terms of when the market will improve, but I don't think it will be this year or for the next several quarters. This is speaking to the market on a countywide basis, but obviously different areas of town perform differently. And as you can see here, there's a wide variation in vacancy rates. Towards the bottom, we have Burbank. That market has really ridden out this, the pandemic era quite well, given the concentration of large entertainment firms in that area. Towards the top, you have other areas that were hot markets, actually, like Hollywood, Culver City, El Segundo. These were some of the most in-demand locations coming into the pandemic. And they have seen vacancies spike quite considerably, almost doubling in some areas. So lots of things going on there, but by and large, almost every area has seen vacancy spike, some moderately, some considerably, and has seen a weakening in the market. Now, one of the key indicators that I have been looking at is the amount of sublease space that is posted on CoStar. And so tenants, they're obligated with a lease to their space. They're trying to sublet, recoup some of the cost of their lease obligation, and they're putting these space on the market. And, as the pandemic wore on, we saw more and more space added to the market. But fortunately, it does appear to have peaked in the first quarter of this year. However, it has only come down ever so slightly. So, I think maybe a stabilization point, something to be optimistic there. But this will need to make significant improvement, in my opinion, for the office market to really start to heal. Now, when you look at sublease space by submarket, it's pretty clear that what I call the hot markets, the markets that were geared towards tech, startup, media, the co-working firms, they're the ones that have the most amount of sublease space on the market. And so I think that speaks to two factors going on. I think it's a combination. I think you have some weaker firms trying to recoup some costs from their lease obligations. And then I also think you have some healthy firms who are reconsidering how they're going to use the office space going forward. And so that's going to be considerable in terms of how that will be a factor, but nevertheless speaks to tech and media, these industries that are really important in driving the market, not being in complete health right now. Now, in terms of where the market could be going, this looks at our baseline forecast, which again, I admit there's a lot of uncertainty here, but I do think it is safe to say to expect vacancies to increase for at least the next several quarters. Beyond that, lots of unknowns and just how are people going to be using office space? Are they going to be back in the office full time? Are they going to be doing some hybrid model? Or are they really going to have more people be full-time remote? It's going to be a mix of both, in my opinion, and to which strategy has the bigger push or pull is definitely up for debate. I think there'll probably be a modest net reduction. It's not going to be that the office is going away, but I think you're going to see many firms go to hybrid. You'll see some people go full remote. You'll see plenty, stick to the office as well. But I do think in terms of all that decision making, probably a net reduction. In terms of rental rates, and this looks at asking rates here, we have seen rents in decline. They've been modest, and so landlords have been holding up rental asking rates at this point pretty much here. I think there's probably some more concessions going on as well in these numbers. And at the same time, the leasing market has been slow. So there's kind of that pause and waiting for the market to clear out in terms of where rates will end up. Looking at rent growth by submarket, it's interesting comparing this to a couple months ago. Rents were declining then as well, but they're declining by less now. So I think we're getting to a point of stabilization, and the spread between rent declines among submarkets has narrowed. So hopefully a relatively positive indicator that we're getting towards the end of this bad period, but something to watch here. In terms of the forecast, we do expect rents to continue to decline for the near term, after which increasing. But again, a lot of uncertainty there in terms of where this will head. On the construction front, we have just over 6 million square feet of office space underway in LA County. This is down from a most recent peak of several quarters ago. It is relatively elevated looking at data from the last several years, but it is concentrated in specific areas. So some areas have supply issues and some don't. And where you see that construction, Burbank, West Los Angeles, and the Olympic Corridor. And so Burbank, most of this is in the Warner Brothers. They're going to be building a new headquarters that will be delivered in 2023, 800,000 square feet. Several other mid-sized projects as well there. In West LA, you have the conversion of the former Westside Pavilion Mall into office space. 600,000 of the 800,000 was committed to by Google in 2019. That's going to be their footprint in LA. There's another 200,000 square feet that remains to be leased, and several projects as well. And so still a relatively full pipeline for the LA County, but it will really impact specific areas of town more than others, and projects without significant pre-leasing probably do face a tougher environment to get their space occupied. Capital markets activity. It has moderated for sure since the onset of the pandemic. But is interesting is haven't seen pricing go down as much as I would have thought. But there's been a concentration of higher quality trades. And it seems that investors have been focused, I would actually say up until the last couple months. But for about over a year, the trades that were really notable were high quality, well leased, buildings leased out for at least 5 years, get you through the near-term tribulations, that more bond-like real estate. That did not see pricing discounts. If anything, pricing maybe rose a little for some assets. And so I think there's a stratification of the best and the rest, and a lot of that rest hasn't traded. But there have been some properties that I would say are higher quality, but do have some lease-up risk. And there was a large trade in the Arts District. This is a building called the Switchyard. I think that's the most notable example. There's a fully vacant building. And so we are starting to see signs of people having more optimism, but I think it'll be focused on specific areas and specific types of buildings. On the pricing front, we do expect pricing to decline. That hasn't happened yet during the pandemic, so I could see this forecast continuously revised, kind of keeping pricing flat, but relatively modest, benign forecast, I would say, for the office sector here. All right, I will shift gears into the industrial sector. Industrial has been the darling of commercial real estate for at least 5 or 7 years, and it is now especially the darling during the pandemic era. Vacancy rose in LA during 2020, but it really kind of was a timing issue to me more than anything. Vacancy still was among the it was the lowest rate, even when it was at its highest in 8 years, among any market that had over 200 million square feet of industrial space. So very tight and in an enviable position, nevertheless, that rise in vacancy. What we have seen year to date is this really strong compression in vacancy. Things have gone down considerably. So I really don't see any headwinds for the sector going forward. Sam Zell versus Starwood rumbling. Yes, they are very much so characters in our industry. So, I think that things are pretty good looking for the industrial sector. Really cannot say too much here. And one of the key drivers of demand is port activity through the ports of LA and Long Beach. Combined, it's the largest port complex in North America. It is the primary entry point for goods coming from Asia, in particular China. And as you can see here in 2018 and 2019, we did see a decline in trade volumes. And that really was a result of the trade war and the rhetoric between the US and China. And we did see depressed volumes earlier on at the beginning of the pandemic. However, we have seen quite an impressive bounce back here. Record levels of trade activity now, and really is a strong driver of demand for industrial space in the metro. This graph is similar to the one I showed for the office sector and looking at gross leases signed during and this is for respective month, over the past several years. As you can see, the leases executed this year, activity has been very strong. Seeing plenty of demand from industrial space users, so nothing negative there. Looking at supply, demand, and vacancy, the green line, has been swiftly declining year to date. So really speaks to a strong market. We're back to almost all-time lows for the market in terms of there just simply is no space available. I would say a 2% vacancy rate essentially means 0% vacancy. You have a percent or two of buildings that are just obsolete. They're not going to get leased. They just don't really work for today's industrial users. So a very favorable market if you are a landlord. In terms of where the market could be going, I think it's safe to say that occupancies, it's going to remain very tight market, very landlord friendly, at least for the near to midterm. And we do expect that for the next several years. On the rents front, rent growth, it wasn't really all that negatively impacted from the pandemic. As you can see in the years leading up to 2020, rent growth was moderating, still pretty strong, but it was moderating. And, while that moderation continued through 2020, we are seeing rates start to pick up. And I do think that speaks to the tightness of the market, the limited options space users have. And we do expect this to continue. Looking at our baseline forecast here, we do expect strong growth, well above inflation for several years. So if the market does remain this tight, I think we can expect rates to continue to increase and reach all-time highs quarter after quarter. Construction levels, despite the strength of the industrial market, you do not see a lot of industrial space built. LA County, most of it at least, is simply built out. It's very expensive to build industrial buildings. Any land, any site that is available likely has a higher and best use as an office building, an apartment complex, if you can do that other use. As a result, we really see most construction in Southern California happen out in the Inland Empire. There's more availability of sites. You can build the latest and greatest new building. And so there's this dichotomy where LA County's industrial stock is much older than most other markets in the nation and stands in contrast to the Inland Empire. And so as you can see here, we just have just under 4 million square feet of industrial space under construction. That's not a lot when you consider we have 940 million square feet of industrial space in LA County. So isn't really going to be an impact on the market. And just to kind of compare construction levels across the country here, you can see LA is towards the bottom with its 4 million square feet. I just wanted to point out the Inland Empire because these markets really do go hand in hand. That is towards the top end, but there also are other markets seeing much more construction. And that is kind of the case in most other markets of the country. They have outer suburban areas, exurb areas with which it's easier to build, land sites. And so this is a great structural factor for LA County industrial. We can't build too much and then end up with a down market where vacancy spikes too much as a result of that supply pressure. And so that's a nice kind of structural factor the market has here and is definitely compelling when it comes to investor demand. This graph is a little complex, but I like to show it. It looks at the percentage of industrial buildings that were built. It takes the square footage of buildings that were built during a quarter minus the square footage of buildings that were demolished. LA County actually does see a fair amount of industrial buildings demolished using those sites for, converting to other property types. And so as you can see here, it looks at those levels and then compares it to the inventory of the year before. Main message here, LA industrial market has seen essentially no net new industrial space for years. We see a modest amount built, but we also see a modest amount demolished year in, year out. Transaction volumes in LA County have been very strong. There was a little pullback early on in the pandemic, but once people, got out of that hunker mode, they've really focused on the industrial sector. And I think it's pretty obvious why. The demand drivers we have in the ports, the continued rise of e-commerce, which is happening for years, but only spiked more during the pandemic. The demand for space, the demand for more space, given the issues of supply chain issues and wanting to hold more inventories on hand. In the years coming up to the pandemic, retailers were trying to be really lean and trying to minimize the amount of goods that they had coming in and out of distribution centers. And I think there's been a pullback from that, just given the uncertainty of whether or not you'll have goods in a place, and you want to keep your consumer happy. All these factors make LA very impressive to invest in, and that has sustained strong investor demand. Comparing markets across the country, LA ranked #1. Looking at our price per square foot forecast, as you can see, pricing was really not impacted during the pandemic, continued to rise, and we do expect that rise to continue. I very much so believe that will be the case for at least the next year. I think barring a major dislocation in the economy, I would not expect this dynamic to change anytime soon. I will wrap up with the retail sector. Now, this looks at gross leasing like the other sectors. As you can see, there definitely was a moderation earlier on in the pandemic, but in recent months, we are getting closer to activity we've seen before. That being said, the retail market was in a position of weakness before the pandemic. For years, the market talked about the retail apocalypse. We had plenty of store closures. We had openings, but not enough to offset the closures. Quarter after quarter, we'd hear. And so the market was in weakness before, but at least we're not as weak as we were earlier on during the pandemic. Looking at this graph with supply, demand, and vacancy, as you can see, vacancy, the green line, has been rising for years. And so maybe there was an acceleration of the rise in vacancy in 2020 due to the pandemic, but these dynamics were already happening, in the market already. Now, in terms of where the market could be going, I think among all the sectors, retail is probably the most uncertain. A lot of structural issues in terms of how retail will be used, how the consumer will interact with physical retail space, what type of physical retail space. And while looking overall, we do expect the vacancies have peaked here and will start to decline, but there's all these different things going on in the sector between property subtypes, between locations, and the market performs very differently once you start to look at opportunities on a micro basis. On the rental rate front, we have seen rates decline a little bit here. I think to some degree this is a pause in the market, but definitely has seen a pullback in the pace of rental rate increases. Look at construction, we're building only 1.4 or just over 1.5 million square feet of retail space. That's not that much. We have over 400 million square feet of retail space, so very modest there. And that had been the case for over the past decade. Developers got the message. The retail had its challenges, and you had to be selective if you were going to build. And most of the construction that has happened has been, mixed use, really trying to resonate that live, work, play environment, something that was more enticing than just a commodity retail center. So mixed use or, kind of smaller, convenient retail here and there, but very small buildings. So very modest supply pipeline. And this graph is similar to the industrial graph I showed, looking at the net percentage increase of inventory during a respective year. And as you can see over the past decade, the supply growth has fallen off quite dramatically. We saw a lot more space being built in the 80s, but now we're seeing the market essentially not grow at all. Looking at transaction volumes, activity has been relatively modest. The last quarter of 2020 is kind of an anomaly there. We saw the transaction of Simon, the largest mall REIT in the country, purchased an 80% stake in 𝐑𝐞𝐚𝐜, another mall REIT's portfolio. And part of that was the Beverly Center at La Cienega in Beverly, very high profile retail property there. And so that really accentuated trade activity. By and large, though, we have seen a bit of a moderation, and maybe we're getting a little close with the last quarter, but definitely some hesitancy with investors. looking at our price per square foot forecast, I think this baseline is modest. I think there will be a stratification. Some properties will fare better, some will fare worse. So it really just depends. But we don't expect, the market to see really strong momentum anytime soon. Now that is all I have in terms of slides today. Does anyone have any questions? You can either enter in the chat or just unmute yourself. I think we have a small enough group.
Yeah, and let me just say, Ryan, that was a brilliant presentation. Thank you for that, quick and thorough information, share of data and information. And yeah, I saw some things on the chat. Open mic, guys. Ryan is here. Please ask away. What do you have?
Oh, Ryan, I really thought you did a great presentation. You really covered all the different verticals, from industrial to construction to multifamily. I thought there was a few key points in there that I had to agree with you, which I was really surprised during the pandemic, how the market kind of reacted. Really, I got to give it to you. You're very thorough.
Thank you.
Let me ask you a question, what your opinion is. Do you think that once this eviction moratorium fades off, we're going to see vacancies dip at all? Or because they're pretty we're pretty low on vacancies right now. And I'm curious to know, like, once that moves, is your opinion that popping around?
I'm not 100% confident on where the market's going to go. I'll just be honest. I think, we have the demand from people that aren't in their apartments moving into, and that's driving strong demand. But I do think that it is maybe overemphasizing or making the market look stronger than it is. Just anecdotally, I have heard from our apartments.com team, particularly lower end properties, there have been plenty of people not paying their rents. Some of these properties collections are 70, 80%. Just jokingly, I'm sure this is an extreme example, but people not paying their rent for a year, but going out and buying a new Corvette. So there is some of that dynamic, and I think that is probably concentrated in the lower market, where when so those people aren't moving out, they're not paying rent, but they're not impacting the vacancy. So eventually they'll have to move out. And so, a lot of that will just depend where the market is at that point. If there are enough people to backfill and come back in, and we have better control of the pandemic and there's greater confidence in the economy, I think that there should be enough momentum. But if things are kind of relatively weak still, uncertainty with the economy and the pandemic, it could lead to a rise in vacancy. But it's definitely something I'm watching, and is really hard to know how it will exactly play out.
My personal take is that we will see an uptick in tenants moving out of state at that point. Once the gig is up, and they've ridden the wave, we'll even see a further exodus, to different markets.
I mean, it's possible, but I think we've seen a lot of that already. There's been a lot of migration to the Inland Empire, and LA apartment rents and Inland Empire rents have never been closer to each other. And so we've had a lot of people leave, and I think it's why am I in this expensive metro if everything's shut down? I don't need to commute to my job. I don't, whatever happens now with Delta and everything, I don't think we're going back to the worst of where we were in 2020. But it is a question of how long this plays out. So, I think we will go back to normal at some point, and people will want to be closer to their jobs, will want to be closer to their family and friends and schools, and that will start to play out. And so I think we're seeing that what has happened in 2020 is really that factor, and people leaving. And I think if anything, as things normalize, that will make LA more attractive again. But structurally, yes, we do have that issue of people continually moving out of the metro. But it's also a picture of incomes. It's lower and middle income people leaving. More higher income people continue to move here than leave. That's obviously a smaller portion of the population. So it also depends where and what segment of the market you're looking at.
Agreed. I definitely agree with that. Cool. I appreciate it.
Good questions, Michael. Thank you. Who else? What do you want to share? What do you want to ask?
Yeah. Oh, yeah. One thing I wanted to add, we need some more CoStar gear. like sweatshirts and hats and stuff like that. Like we're like long overdue here.
Michael, when I get some more swag, I'll definitely drop some by for you, okay?
Yeah, this is the last thing I got.
I know.
That's commercial, ads, 20 seconds ads. Yeah. Okay. Do you have anything? Ryan, shout out to you. Ricky, thanks as always. That was a great presentation. And Ryan, if you don't mind sharing that PDF version of presentation with me so I can send it to the group, they can dig deeper and, have that information available.
No, absolutely. And at the back of the presentation, my contact info is there. Please feel free to give me an email, a call. That's what I'm here for. I'd love to talk to you if you have any other questions.
I thought one point I got to point it